Hey everyone, you're listening to the recap by Drawing Capital, the best place to dissect the week's key events and investing in technology in 15 minutes or less. The information provided is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by Drawing Capital, nor a recommendation by Drawing Capital to buy, sell, or hold. Listeners should determine for themselves whether a particular service or product is suited to their needs or should seek professional advice for their particular situation.
All right, everyone. Well, let's get right into it. Busy week this week. Elephant in the room, and something we've all been waiting for, were the Fed comments earlier this week on the 16th and 17th. Um, just as a recap, Fed remains very accommodating for equity markets. No interest rate hikes expected until possibly 2023. Powell reiterated that he expects inflation to be transient, but is otherwise at a low level, sub 2% still. QE and bond buying programs, quantitative easing and bond buying programs are expected to continue as they have been, to the tune of $120 billion a month. And just to recap again from last week, the Dow index was up 7.12% 1 week ago. Year to date, this week we are up 6.16% for the Dow, so it's dropped a bit, as is the same with the other indices. S&P up 3.78% year to date versus 5.02 a week ago. NASDAQ down officially for the year, 0.39% versus positive 0.37% last week. And then ARKK, ARK Invest Innovation ETF, is also negative for the year now at down 1.71% versus 1.68% last week. The culprit, the 10-year Treasury, which was a yield of 1.63% 1 week ago, stands at 1.725 today. Sagar, we had discussed discounted cash flow models and their effect on growth stocks versus value-oriented stocks. Can you give our listeners a rundown of why the 10-year is having such a profound effect here?
Sure, it's a great question, Sean. Overall, when interest rates rise, it can create a rise in discount rates. And why that's important is that when you're discounting the future cash flows of a business, which is a traditional way of valuing most financial types of assets there, then what happens is as discount rates increase, then the net present value of those cash flows decrease. And what that ends up implying is that when the present value of those cash flows, or said differently, the current value that investor may be willing to pay uh, goes down, in which case this is just a recalibration effect where investors are recalibrating what are the types of prices that they're willing to pay. And in some cases, they're willing to pay a premium in order to stay invested in the highest of quality, best in class type businesses, or they're willing to drop their return targets by staying invested at current prices, even though the future cash flows are the same. Now, in other types of businesses that are very much in the growth oriented stage of their business cycle, that is where future cash flows can really exponentially increase in certain specific sectors or certain specific companies. And that is really the way that many growth investors recognize long-term gains is when they're buying at a business today, they're not just looking at price multiples of saying, okay, for the next 12 months, price multiples may be expensive, but if a business is growing at over 100% a year over year for the next 3 to 5 years, then it may not seem so expensive today if the business continues to execute on its vision and have deep conviction in its operating philosophy in achieving their core mission as a company, as well as serving their customers. So I guess long story short is rising interest rates do impact price multiples. They impact how long-term investors that use discounted cash flow analyses conduct their analysis. But at the same time, we have to also keep in mind that interest rates, despite rising on the longer end, they're still very, very low compared to historical norms. So from that standpoint, it is still very much an accommodative interest rate policy. And as Sean reiterated, the Federal Reserve and Chairman Powell made comments to suggest that there's going to be continued expansionary monetary policy for the next few years.
Jugal, anything else you want to add to that? It does seem that although the comments have been very accommodative from the Fed and Chair Powell, it really seems that investors in the market are still a little bit skittish. What are your thoughts there?
Yeah, my primary thought about just listening Powell speaking, the thing he can say the most is things are not going to change in the near term. There's going to be stimulus going on. We're waiting for a substantial recovery in the U.S. economy before interest rates rise. And I think after saying that sort of thing for so long, and the way that the rollout of the vaccines has been going on for the past year, this marks the 1 year period since COVID really started in the U.S. I think a lot of that low inflation is a little too priced in right now. I think people have made these financial models where they're expecting these interest rates to be low for potentially another year, maybe even longer. And if you have those models, that worried about these interest rates being this low, then the issue is once these interest rates go up by even 0.5%, or as we expect 1% sooner or later, and Powell has mentioned that we're going to be above 2% at some point because we need the average to be at 2% for it to be quote unquote normal. I think that really just tears apart a lot of the financial models that a lot of these firms are using, and that causes the multiples in these growth companies to contract significantly. And I think the worry is it's justified at this point because we are a year out of having those low inflation or those low interest rates. And I'm actually myself also a bit worried that interest rates might rise sooner than people think. And I wouldn't honestly trust Powell's comments 100%. I would, more on the side of 70% or 60% at this point.
Yeah, and I guess that kind of echoes what everyone else is thinking, and therefore what the market is showing at this time is, although things remain accommodative now, what if things change later this year? Inflation isn't just transient, and as a result, interest rates rise sooner than they otherwise would have, and people are kind of prioritizing companies that are profitable and paying cash flows forward now. Speaking of cash flows, just to shift gears a bit here, we've been talking a lot about different payments platforms this week. Sagar, I want to turn it over to you. There's some exciting stuff going on. I know you're kind of on the forefront of that, our frontline research. What are you seeing there? Why should people be excited? And really, who's leading the charge on the payments front?
Sure, it's a great question. I think there were two ideas in particular that we did deep dives this week at Drawing Capital, in addition to a lot of the other research that we're doing. But two trends that we've already been seeing are the following. One is the buy now and pay later category, and the second one is the early paycheck access products. And so, kind of double clicking on both of those, I'll start with early paycheck access. So these types of products really allow employees and workers to reduce the waiting time to receive a paycheck. The rationale for this really started with the following question, which is if an employee works for a company every day, or really every workday, and if the employer receives value from the employee every workday, then why does the employee need to wait 2 weeks to receive the paycheck? And in today's environment, where estimates suggest that more than half of Americans are living on a paycheck to paycheck basis, having earlier access to paychecks creates value for people. And so we've seen some examples of this both in larger companies as well as in the startup ecosystem. So for example, there is companies like Earnin, there's PayActive, and then Uber also has an instant pay product for the Uber drivers there. Now, in the buy now and pay later category, this really connects also into fintech and e-commerce and all of those trends that we've seen. And I guess speaking of e-commerce, I remember reading last month on the Federal Reserve's economic database website that e-commerce retail sales reached about 206 billion in quarter four of 2020, which represented about 14% of total retail sales in America in quarter four of 2020. So I guess for a comparison, 10 years ago, e-commerce retail sales as a percentage of total retail sales was about 5%. And then as of last quarter, this percentage is now 14%. So we can really see the growing adoption of e-commerce retail sales there. And then in the buy now, pay later category, this is really a fintech application in e-commerce financing. So there are three main large providers among many in the buy now, pay later category. They are Klarna, Afterpay, and Affirm. And the cumulative market valuations or market caps of these three companies is currently about 75 billion, demonstrating investor validation of these buy now, pay later business models, as well as favorable consumer adoption of buy now, pay later. And then also on a related note too, there was the FIS WorldPay report that was published last month, suggesting that the adoption of buy now, pay later is estimated to double in North America and Europe by 2024. So we're seeing rising adoption. We're seeing another way of how fintech can improve consumer experiences and really deliver more value. And at the same time, these are valuable businesses and investors are willing to pay up for fintech deals in the private markets, as well as be really involved in the merger of finance and technology in the public market as well.
Yeah. Jugal, kicking it to you, my friend. What are your thoughts there?
I think overall, and I've had these thoughts for a while now, but the way that I think all this sort of payment stuff should work is that you should be paid whatever you're owed by the second, by the millisecond, if possible. As we're getting into a more digital age where these things are possible, I think it's inefficient to have someone be paid every week or every month or every year if there's some sort of annual contract work that you're doing. The reason being that this sort of step function in your salary causes inefficiencies in how you spend your money. You never really know what your paycheck is going to be until it's in your hand. So there's people out there that don't know if they're actually going to get paid at the end of the week. Something potentially happens with the company that they're working for, or perhaps they'll get fired, or maybe they'll be laid off. So that sort of behavior causes them to act risk averse. And that way they spend less money into the economy, which leads to potentially lower GDP, et cetera. So I just think that the future is actually getting paid on a smaller time frame. And I think that's going to have vast impacts on money velocity. And yeah, I just think that is the future that we're working towards. And we're still a long way from it. But I think in the next 2 or 3 years, we could see substantial progress on being paid daily across the entire U.S. population rather than just a subset of early adopters of this technology.
Yeah, I think daily might make some sense given what people are demanding nationwide. I do think there would be a point of some diminishing return where if you're getting paid, every second or every millisecond, especially if it's a part of the population with lower salaries, if you're getting a few cents every second, that's not quite enough to transact in any real good or service anyway. So I suppose that would need to match for one, and then possibly two. I think there is a good portion of the population, probably a minority of the population, but still a good chunk, myself included. I think you guys are in the same boat.
Let me just add a quick point there. If you're getting money every second and you're able to actually get interest payments on that money every second as well, then the effect of compounding is extremely high. And so the smaller the time frame, the more money you'll make by the end of the year. And I think that would have profound effects for a lot of people that do actually need a couple extra dollars here and there.
Yeah. Yeah, you may have banks say, though, that we're not compounding it every with greater frequency, just
yeah.
So you get access to the payments. Then it might be a losing proposition for them. Anyhow, thank you everyone for listening. This is all the time we have for this week, and hope to see you next week.